All right, in this video, I'm going to talk about stock option plans, specifically employee stock option plans. Now, stock option plans function really a lot like warrants. An option, just like a warrant, grants the holder the right, but not the obligation to engage in a particular transaction at a particular transaction price. So employee stock options are given as compensation, as pay to employees, and they give the employees the right to buy shares of the company they work for at a set exercise price. So for example, executives who work at, pick a company at Kroger, might have, as part of their compensation package, they have the right to buy Kroger shares from Kroger at, pick a number, say $20 per share. The purpose is to encourage employees to work to increase the stock price. It's one thing to give people cash. It's something else to say, look, you get paid if the stock price goes up. And the reason they want to do that is to align employees' incentives with shareholders' wealth. So the idea is shareholders get better off when the stock price goes up. Let's make employees better off when the stock price goes up as well. And there are some complicated reasons with regard to risk and those kind of things that made these pretty popular in the 90s and the 2000s. One of the reasons they were really popular in the 90s and the 2000s is because while these started growing in popularity, there was no requirement to account for them as compensation expense. So employees would get things of value. Current shareholders would find their shareholdings diluted because employees were getting new shares of stock, but there was no expense for this recorded on the company's financial statements. So current shareholders didn't really see the value of their company declining in the financial statements. So there was sort of a loophole in the accounting that made them very popular. That loophole has been closed, and so that's what we're going to talk about here. Now, we need to talk about it partly to understand the closing of the loophole, but partly also to understand dilution. And this is important for understanding diluted earnings per share. But this is a quick overview of stock option plans and sort of how they work and why they exist. Now, there are two kinds. There are non-compensatory, which basically means non-compensation. Employees aren't really getting a whole lot of value. And then there are, of course, compensatory plans. So let's start with non-compensatory. In order for something to be considered non-compensatory, that is, in order for the FASB to determine that employees aren't really getting paid much, there are four criteria that must be met. First of all, substantially all employees must be included, so it's not reserved only for top executives or something like that. Stock is offered equally to all employees, so again, it's not like everybody can buy one share, but the CEO can buy 10,000 shares. No, it's got to be basically offered equally to everybody. The discount from the market price is small, so let's say the stock is currently trading at $50 per share, and the discount is you can buy it at $48 per share. Not a real great big market discount. And there's a short amount of time to exercise. So employees can't hold on to these for a long time waiting for the stock price to go up a whole bunch and then exercise them. So basically, there's really not a lot of value to these kind of plans. And if that's the case, FASB says no compensation expense must be reported by the company, which makes sense because employees aren't really getting much. There's not a lot to talk about here. We'll move on. The ones that we really need to talk about are compensatory stock plans. And these are ones if any one of the criteria before are not met. So if not all employees can participate or not all employees get equal access to the number of shares of stock, if the discount is large or if there's a long period of time to exercise, then it would be considered a compensatory plan, in which case the company and the issuer will recognize compensation expense. So if we're talking about Kroger and Kroger has a compensatory stock plan, then what would happen is Kroger would have to recognize compensation expense that it's paying to its executives. The amount of compensation expense that will eventually be recognized is determined on the measurement or the grant date. So when the company decides we're going to give this number of shares of options to our employees, that's the date on which they sort of look ahead using a pricing model and determine how much compensation expense will be recorded. So it's sort of a look-ahead estimate. It's not something where every period we kind of have to figure out what the stock price has done and reconsider it. On the day we do the measurement, we look ahead, we do our best estimate, and we try to figure out what the value of the compensation will be. So on this measurement date, or on this grant date, the total number of shares to be given to employees is known, and the option price has been determined. Again, that's the price at which employees can purchase the shares of stock. That's not the future market price. That's the price that employees have to pay to get shares of stock. The compensation expense is determined using the fair value method. Now, what does that mean? A fair value pricing model is used to determine the total compensation at the measurement date. So again, let's say it's today, and Kroger decides to give its employees, its executive, 100,000 shares of stock, or 100,000 options, excuse me. Right now, they would run this decision through an option pricing model. The most famous one you may have heard of in a finance course would be the Black-Scholes model, and it looks at things like volatility and likelihood of being exercised, and kind of tries to take a look at future uncertain variables and figure out what the value of the option, but not the obligation to buy shares of stock at a certain price. It tries to price that. In this class, we're just going to give it to you. This is not an option pricing class. You can take one of those. I'm not going to be the guy to teach it to you. So in this case, you'll just be given a dollar value, but this is just a little bit of background on where that dollar value comes from. The compensation amount, the total amount, is then allocated to expense over the periods or years that services are rendered or given to the firm in order to earn the options. So in other words, if the Kroger employee has to work 5 years in order to earn all these options, then the total compensation expense would be divided by 5, and each year 1/5 of that would be recorded as expense. So we're going to take the total fair value and we're going to apply it to expense in a straight line method over the number of years that the employee has to work. Usually you have to work for a long period of time. It tends to lock employees in. It gives them a longer time focus. And it also allows people like top executives a couple or 3 years to get their strategic plans in place and operating and those kind of things. When you're working at the highest levels of a company, sometimes the changes you want to make can take a year or two to really see the benefit. And so it's an opportunity to make sort of a long-term compensation plan. So conceptually, this is what's going on with the compensation expense. We're going to come up with a total fair value based on a pricing model, spread that out straight line over a number of years. Now we've got some transactions to record. We are accountants, so we want to think about recording the transactions. First of all, as always, T accounts are your friends, particularly with the APIC accounts we've got. We're going to introduce 2 new accounts for this topic, APIC options and APIC expired options. There's basically whatever kind of APIC you want to have, you can find an account that has that. So these are the 2 new accounts we're going to introduce. We're also going to use some language called compensation expense in these journal entries, which is really just a generic term for any kind of a salary or wage expense or cost. And even if you've got someone like a COO, a chief operating officer, and a portion of that, it would be in manufacturing overhead. You could even think of it as overhead. But we're just going to think of compensation expense essentially as including any kind of cost we would charge a compensation to. And there are a few helpful concepts that are not sort of explicit accounting terms, but they're helpful for us to understand how to do some calculations. There's the idea of the fair value per option. So before we talked about the total fair value, here we're going to talk about the fair value per option because sometimes you'll do some calculations that don't involve all the options. And so it's just nice to have that idea in your head. And also fair value per option per year, which is helpful when employees leave. We've got a reversing entry we've got to make, and it's helpful to have in your mind, well, what portion of the total fair value have they earned before they've left? And that's going to depend on the number of years they've already worked. All right, so let's get into our specific options transactions. On the grant date, when we grant the options, when we do the measurement, when we know how many shares they are and what the exercise price is, and we run it through that fair value pricing model like the Black-Scholes model, we actually don't have a transaction on that date. We have a promise to engage in future transactions. So just like signing a sales order doesn't incur revenue, deciding in the future to pay options out to employees does not incur any expense. We've got no entry on the measurement date or the grant date. Every year we have our annual compensation expense. And we would debit expense and credit APIC options. And this is that straight line fair value for the year thing we talked about a few slides back. So whatever the total fair value is divided by the number of years. As the employees work and they earn their compensation, the company has to record expense. So we're going to debit compensation expense. And this credit is sort of representing how we pay. So instead of crediting cash, which we would pay if we were paying in cash, or instead of crediting salaries payable if we were planning to pay in cash but hadn't paid yet by the time we made the entry, here we're saying, well, we're not paying out anything in cash, but we are increasing our additional paid-in capital for options. We are planning to pay these employees with stock, so we're planning to have a more contributed capital. You can think about it sort of two ways. You can think about what were we paying the employees with, or you can think about what are the employees buying the stock with. They're not buying the stock with cash. They're buying the stock with their effort, with their labor for the business. So you can think about it as how is the company getting capital contributed? It's getting contributed not by cash, but by labor. So you can think of this journal entry as sort of making sense from either direction. So when employees work, we debit compensation expense, we credit APIC options. And we do that for every year that the employees work, and assuming they just keep doing that, by the end of the exercise, or by the end of the working period, we'll have credited APIC options for the entire fair value and debited compensation expense once every year for each of those years. When employees exercise options, remember, exercising options doesn't mean you get the stock for free. It means you have the right to buy it at a particular price. So the employees would trade in their options and their exercise price. So they would give up their right to buy shares, and they would give up cash, and they would get shares of stock. So now we are getting, the company is recording more stock. So we're crediting common stock at par like we always do. And we're going to credit APIC common stock at a plug like we always do. And we're going to debit cash for whatever cash we receive. And the difference between the exercise price and the exercise price plus the fair value for option, is what is the total sort of value of the shares we give up. So you can think of this as the employees having already paid their labor. That's what's showing up in the APIC, and now they're paying the remaining cash, and in doing that, they've contributed everything they need to get the shares of stock, and then we record the shares of stock here. So this is how our sort of normal transactions, we record the options, and then as the company issues shares of stock and the employees exercise options, we record that. Two more transactions, and here are weird things. We always have to have weird things, or else it's not an accounting class. So what are the weird things? So one possibility is that before the employees before the employees get all of their options, they might quit, or they might get fired, they might find another job, whatever it might be. So we have to worry about terminations of employment, not terminations of people, just terminations of employment. And sometimes options expire. For whatever reason, people choose not to exercise their options. So if employees terminate during service, and here's really the weird one, we have to reverse their compensation entry. They've been paid with options, but now if they leave the company and in leaving the company, they don't get to keep and exercise their options, what we really need, we need to take the options off the books. We no longer have this obligation to our employee to issue the shares of stock. So we're going to take the options off the book, and here's where that fair value per option per year is helpful, because if the employee's only worked 2 years out of the 5, then the employee has only earned 2 years worth of the total fair value. So total APIC options is going to be debited. Take that out of your APIC options account for the fair value per option per year times the number of options given up times the years that the employees have worked before they quit. We're going to credit compensation expense. We're going to undo the comp expense that we've previously recorded. Now, yes, this will generally fix the compensation expense in the wrong year. For example, someone who worked in year 1 and quits in year 2, we're going to make this journal entry in year 2. We don't know during year 1 that they're going to quit next year, but when we find out that they quit in year 2, we'll make this journal entry. That fixes the problem in the wrong year. So what? Who cares? So this is weird. but we have to understand that we don't have perfect knowledge, and as we get better knowledge, we just go ahead and make our updates. So that's the one weird thing. The other thing is what happens if options expire after the person has worked for us. So the person works for us for 5 years, has the option to buy shares of stock, and just for whatever reason never chooses to do it, never has enough spare cash to buy the shares, the stock price never goes up enough to make it worth doing, forgot about them, who knows. For whatever reason, the person doesn't exercise. When at some point the options will expire. You don't have an indefinite period of time to exercise them. What do we do as a company when the options expire? We have to remove these expired options from APIC options because there are no longer any options out there. And then we have this new account called APIC expired options. So basically we've got paid in capital that employees worked. They earned the right to buy shares of stock. We never gave them cash, and they never bought the shares of stock. So they've essentially kind of worked for free if you think about it. Now, we debited compensation expense, we credited APIC options, they earned the right to buy shares of stock, and then they just said, no, thank you. So in a sense, they worked for free, which is weird. That's their choice. So in that case, we're going to credit APIC expired options. And what this kind of gives us is a measurement of, in a sense, what we got for free from those employees because they've chosen not to they've chosen not to exercise their shares of stock. Now, if they didn't exercise their options, it's probably because the stock price didn't go up that much, which probably means what we got for free from them wasn't that good of a service, but whatever, is what it is. This is our other weird thing that we have to do is expiring after service. So this is conceptually what is going to happen, and then I'll go through a numerical example and work all these things out, and that's when everything starts to make more sense.